My name is Luca Facchini, and I'm going to talk about the quantitative methods and systems that I created during the years. Thank you for coming and attending this webinar. I hope that you will like it. And let's start with the first slide. Pretty much wants to talk about my background. I've been working in the financial markets and trading for over 20 years. I work as a system developer for a long time, creating programs for position trading, spread trading, swing options programs, and day trading. Also, I've been working as a money manager and a market analyst at the beginning of my career as a market analyst and market money manager for a while during the years. I'm a published author and public speaker. I spoke for important in Europe for important seminars sponsored by CQG, very important banks, and also I wrote for Bloomberg in Italy for a while. I did consulting for private and institutional clients that they needed some advice on trading commodities during the years when I was a CTA, and especially when they needed some kind of special indicator or program for their trading. Recently, I developed a proprietary software for risk control and trading applications for prop houses and for brokers. Again, during the year, I work as a commodity trading advisor and also as a futures and option broker for over 15 years. So that is pretty much my professional background, and I'd like to explain to you what I saw during the years as a trader and as a professional. The two main approaches to trading. And the first one, the discretionary trading, is the one that everybody starts with, I guess, the majority. Buy a book or two and open an account and start trading. And trading really with a few ideas of what you really to do on the market. Some people are very good at the discretionary trading. They have set rules and they have a kind of a sixth instinct for trading. But in my experience, it doesn't last a long time. When I was a broker, I saw many of my clients doing incredible results and doubling their account in 1 or 2 months. And by the third month or by the third week, maybe destroying the account and destroying everything that they built in a short period of time. Discretionary trading is very difficult to maintain success during the weeks, the months, and the years, because psychologically we are weak, and to maintain this kind of performance day after day is very, very difficult, especially for day trading. Probably for position trading, if you have an approach where you enter a trade once or twice a month and you last few weeks, and you're disciplined enough to take the huge loss you're going probably to have, and then have the courage after a huge drawdown to go back and trade one more time, then maybe you can be a discretionary trader. But overall, I found that discretionary trading is a very difficult to do in the long run. I personally prefer to have a systematic, mechanical, or quantistic trading. A lot of big words, but pretty much means that you have a set rules and that you're going to respect those rules. Not you personally, but you'll have a computer or a program that will actually place the trades. And at the point, your emotional part of the equation is taken out, and the computer or the broker it will execute in a cold and disciplined manner the various signals that your system or a third-party system is going to create. It is not easy to follow even a mechanical system when you purchase a system, and I speak for personal experience or friends or all clients, because when you are actually in charge of the system, then you can still override the rules of the system. And when it's time to exit, you can still, kind of cheat and don't respect your stop loss, or if your target is 20 points and you see you have 10 points, you can still try to exit that at the point, So it is very difficult to trade also in this way if you don't have a lot of discipline. I believe that the holy grail of trading is the discipline of the trader, and if you're disciplined, you can do well in discretionary or in systematic. The systematic is a little easier as a way to trade, especially if your systems are working with a broker on a server where you don't have access. You cannot intervene and try to modify the orders that are going to be fired by your signal, by your system. If you have access to that, then you can always find a way to cheat. That is my experience during the years. Another way that I think is very nice and a lot of professionals use, especially in the prop houses, is the semi-discretionary, what I call a gray box trading, where basically they have a very strict set of rules, but they still leave about 10 to 20% discretionary inputs in their trades. But they are also monitored by, generally speaking, by a risk manager that will immediately intervene if they go out of their parameters and they don't respect, for example, their stop. So they have a way to make sure that you don't go in a huge drawdown or you blow up an account. A lot of private traders and retail traders trading by themselves, unfortunately, they are not able to be disciplined in the long run. Again, it could be 2-3 weeks or 2-3 months where you're doing great, but then there is the week where you suddenly are not feeling well mentally or physically, and suddenly your discipline goes out of the window, and so goes your system and your profits. So that is pretty much the three different kind of trading approaches that I saw during the years, and I prefer of all these the quantistic, second the semi-discretionary or gray box trading, and last one the discretionary trading. You can still do that, but you have to be like an athlete. You have to be on top of your game, and you have to be very disciplined, very concentrated. And it's not, if you have a job, if you're working, if you have a career, your family problems, whatever, it is very difficult to do that every day, constantly, and be successful in a long run. So let's go on to the next slide. So one of my favorite discretionary way to trade is I still think the pivot points of way to trade off the floor is a good way to do it. And the pivot points I'm sure a lot of you know exactly what I'm talking about, but they were used on the floor, and they give you support or resistance level that you can use during the trading session, for example, to find area where you can buy or sell the market. It could be any market, really. The problem with the classic pivot points is that they are used by too many traders and don't work particularly well right now anymore, especially. So about 10 years ago, I developed a series of support and resistance levels that are a little different, and I believe a little more accurate than the classic pivot points. What I like about the pivot points support resistance level is that they're leading indicators. So basically, they are not lagging indicators like the majority of the indicators that we're using when we are programming on a quantistic point of view. So they are leading the market. So you can enter, for example, with a limit order or with a stop, and before a lot of other people enter the market at the same price or a little late, waiting for the indicators to also see that something's going on at that particular resistance or support. So, and on top of this static, I created this kind of support and resistance levels, static similar to the pivot points, and also added some dynamic levels and an indicator for the bias, and an indicator that will identify the sideways markets before in early part of the session, so you know if it's time to fade the market or go with a breakout. At the beginning, I was using other software for trading. Back then, we also had a room for a while, but The indicators now, they are available only through Sierra charts. I program there everything, and somebody wants to try, they can definitely try these indicators. So this is the classic formula for the pivot points trading. Probably you saw it a million times. It's still calculated by open, high, low, close, and will create a support and resistance level. So R is for the resistance and S for the support. They're static levels, though, so they are not super adaptable to the following trading session. So the proprietary pivot points that I created are a little more dynamic, and even the static, they're a little more accurate. So I call this the Qst Trading Plan. And so these algorithms that created these levels are proprietary in nature, but they're mathematical formulas that I created, and also the calculation used some elements of market profile, volume profile, and other studies that I developed during the years. Again, this is not a black box. It's still a discretionary method, but of all the discretionary methods that I saw during the years, that I learned, that I saw from clients and colleagues, I believe this is the one that I like the most. That I think it could be the most profitable for somebody that takes the time to learn how to use the plan and the levels that shows up every day on your charts. So the static levels show up immediately after the close of the current session, and you can modify that, but that's pretty much similar to the pivot points, the classic pivot points. The other indicators are more dynamic, and they will show up after the session starts based on whatever is going on at the beginning of the session. The basic methodology is very simple: buy support level and sell resistance levels, especially if the buy low and sell indicator is present. So this buy low and sell indicator will show up on your screen and say, today we think that the market is going to be sideways. And because we know that trending day or run-up day, all the way up, all the way down, happens probably no more than 20% of the time, maybe 30%, it depends on the time of the year. We also know that the majority of the traders like to trade breakouts, and so what a lot of people do, professionals do, is basically if the market goes up, they're going to sell, fade the market, the public goes by, and suddenly they're stopped out. And vice versa, the market is, especially the index with the bias to go up all the time, the market goes down, a lot of people start to sell, and they see this as an opportunity to make a killing with the sell stop, and for sure at that level the professionals start to buy, and the market turns around, and all the public and the retail are going to be killed. And so by buying support, and these support levels are often where the public sells, and by selling resistance, and so the resistance level is often where the majority of the people, the public, the retail are selling. Are buying the market. The professionals usually make money because usually the market are choppy. They don't go in trend up or down because that would be too easy. So they fake you believing that for the first 30-45 minutes the market is going up, and then sure enough it's turning around, and vice versa. If the market is going down, it will go up. Again, nothing is perfect. Nothing is 100%. Otherwise, this would be the real holy grail. But from my experience, if you follow the rules and the buy low and sell indicator, especially on the indexes and the financial markets, 3 out of 5 sessions you will stay on the right part of the trade, and you will trade correctly. And again, another part of the holy grail equation is, beside the discipline, is also the money management. So be able to respect your stop, because that is the number one reason why people get killed on the market. I speak from a personal point of view because I saw hundreds of clients when I was a broker, and I still talk to my colleagues, and they, nothing's changed. In 15, 20 years, people are still making the same mistakes. The market goes against you, and you start to pray and hope that the market is going to turn around, and you don't respect your stop that you impose, so you even move your stop down a little bit more. You start to maybe even scale in. You add into a losing position. And if you do that, for example, in a session like today on the crude light, the market went down almost 5% in one day. and you don't respect your stop, you're going to blow up your account. You're going to lose $2,000 per contract. So that is a part of the discretionary trading that is very, very dangerous. So go to the next slide. So okay, so you have to have a plan. You need to have a bias. As a bias, I mean the potential for a market to go up or down. We don't have certainties in the market ever, but we believe that the bias for, say, for example, for today, for the crude light was down, and the market went down. It could be the opposite yesterday or 2 days ago for when the market went up on the Dow Jones, for example. And again, risk and position management is very, very important when you trade discretionary. So these are the elements of the Qst trading plan. There is a pivot bias, and that is pretty much what is like a sand, a line in the sand. If the market is above this pivot bias, we believe that the market is going to be bullish for the rest of the session. If the market is below that pivot bias, then we believe that the market is going to be bearish. Of course, we're talking about in a context of trading, and is still, you have to use your brain when you're a discretionary trader. Okay, if the market is crashing, something happening in the middle of the night, and for whatever reason you're still above the pivot bias, but the market is crashing, okay, you have to change your opinion quickly, because this is not the holy grail. You have to also use your brain and thinking, okay, if they're just bomb Syria, something's going on, I'm not going to sell the crude light, I'm going to buy it. Okay, no matter what the plan says, no matter what the levels say. So we have two reversals. One is above, so it's a reversal high, and one is the reversal low. When the market touches this reversal high or low, the market has a tendency to stop there and go test the level below. So the market goes to reversal high, go to reversal low, and vice versa. So these are good areas where you can sell the market or buy it. And usually these are the area where the majority of the people are actually buying or selling the market. What is a BH? BH is a breakout high, and if the market stays above this level, there's very good chances the market will stay bullish, or BL, or market will stay bearish for the rest of the session. TH is a target high, or is also called the projected tomorrow high. And so basically when the market stays above the breakout high, has a tendency to go to the target high. When it reaches the target high, often will reverse to lower prices, okay? Especially if this target high is reached in the first hour or two of the trading session. There are other two levels above the target high and the target low. It's the same concept. Is the second target high or second projected tomorrow high. Look for reversal to lower prices. So these are a point where you can actually do the opposite. You will try to enter against the trend, taking small stop and trying to have to catch a reversal. And then there is a third target high, or the third projected tomorrow high. This is a rare level. We saw it today on the crude light when the market goes crazy and goes in a huge bull run or a huge bear crash. And these are the extreme of the market. They happen very rarely, and sometimes they're also they are good prices, level prices for a sell or a buy. Let's see some example. Okay, these are, for example, on the S&P 500. These are an old slide, but the old prices, it doesn't really matter. So the PB is the pivot bias. So anything above this level, we buy it. Everything below this, we sell it. These are reversal low, breakout low. They, of course, they have different pricing going down or up. But sometimes they form what is called a cluster. So you have like 2 or even 3 levels touching each other. So these are the static levels. Then we'll have also the dynamic levels. They basically help each other. And sometimes you can have a pivot bias together with a dynamic level, or or another level too. I will show you soon in some example. So these are basically a quick strategy example of the way that you could use the level on the market. So we have the pivot, and I call pivot, but it's actually pivot bias at this level. 12.15, the market is coming up. When it reaches 12.15, you just have a sell limit market waiting and you will basically sell when the market is the level is touched. Then you'll have, of course, a bracket with a buy stop. Always you need to have always your buy on the machine. Don't use mental stops, because that's a good way to kill yourself. And then you will have a target. They could be, I don't know, twice the stop or 3 times. It depends. So this is strategy number 1. It's a simple fade. The market goes up, you sell resistance, okay, with a limit order. The danger is that if the market carry on and just goes up super fast, you're going to get stopped out. That's it. Then you can try again to sell different levels, but you're going to get killed. So the other strategy number 2, you can fade and kind of front run the level of your ticks, because you will see on the plans that many times the market will approach 2, 3, 4 ticks before the level, and then will just bounce away. So you can fade and enter maybe with a sell limit 1 point before or half point before, and then place the stop maybe a point before in the case of the S&P 500. Again, you're still fading, you're still selling resistance in this example. The opposite will be true, so you're buying support. This is strategy number 3. Basically, you straddle, you fade, you do scaling of one contract first, so you enter maybe one contract 1 point before, and then you sell a second contract 1 point after the level of the plan. So now you're in with 2 positions with an average price of 12.15, and you will place a stop loss at 12.17, for example. So basically, you enter a little early and after, hoping that the level will keep the market from going any higher. This one is strategy number 4, is a reversal with timing for entering a breakout once the level is tested. Personally, this is my favorite. I like to see the market touching the level, maybe even go above the level a little bit, and then using some kind of timing. By timing, I use, for example, a simple breakout of the low in this case, or a breakout of the high if you're buying. So I want to see that the market is actually feeling that level and it wants to go in my direction. Again, there is no guarantee, but at least the market shows that it stopped for a while and now is going in my direction. So the strategy number 4 is my favorite. Now, on top of that, I usually also have a way to prepare my daily trading session, a daily bias. So the PB, that we say the pivot bias, is something important that I look to, but also I like to see what's going on the cash, on the S&P 500, on Wall Street. I like to see some fundamental cash indicators such as the twin, the tick, and advanced decline. I like to keep a look on the banking index and also on the NASDAQ and the Dow. Then, for timing, you can use also classic indicator as a MACD, stochastic, or moving average, exponential, 20, 35, 50. It doesn't really matter too much. At the end is the way that you respect yourself and manage your entries, and especially your exits. The market will give you always opportunity to enter or to exit during the trading session, but if you don't have the discipline to maintain and respect your plan, then you're going to lose by the end of the week, or the month, or whatever. As a time frames, I like 5, 15 minutes, 30 minutes, or 240. So I like to have a multi time frame to make sure that usually I trade with the trend if I decide to do that. I can also go down to 2 to 3 minutes if I'm looking to scalp. But overall, these are the time frames that I'm looking for day trading, and especially to create the daily bias for the market. You can use Fibonacci retracement if you like them. I'm not crazy, but a lot of people use them, so they're kind of self-fulfilling prophecy. If you are aware, also use market profile. You can also put into the mix the value area high, low, the point of control. I don't know if you know what they are, but you can also have this on the normal market profile, but also on the volume profile. These are a little more technical, a little more advanced, so I don't know how many of you are aware of this, but many charting packages are giving this for free now, It used to be very expensive, but now, for example, Sierra has an awesome package for that. And then I use other proprietary setups and studies that I'm not going to discuss here, but pretty much this is the 90% of whatever I would use or used in the past when we had the room, for example, to identify the level to enter and exit. So this, for example, is an example of 2009 when we were trading the S&P 500, September 2009. And you can see back then I was using Signal, yeah. But anyway, you can see the levels of the plan. These are not specified, but you can see, for example, that the long area was this cluster, 871, 869. So this was the support area around 8:30 in the morning, just before Chicago time during the opening, and the market. Sorry, this is Pacific Standard Time. 8:30 Pacific Standard Time. We have the long area, 71.69. After the opening, 6:30 in the West Coast, we had an area 77.79 that was our area for sell. So, if you use the breakout, you would just go short here around 78, and here probably will go long around 70. You just place a stop below this swing and place a stop above this swing, and then you use a target that is like twice the stop. Or there are different methods that you can use for targets. I'm not going to discuss them here, but there are different ways to identify a target. But this is just an example to show that the plan worked. The levels worked a long time ago, and they're still working. This is actually the NQ on Sierra chart just I think yesterday or the day before, I can't remember. But you can see this RH, the reversal high. The market went basically one tick from the high of the session, and it went down, and then it tested the reversal low, bounced up, then went down again, close to, this is a kind of a cluster because you have a BL and a PB close to each other, so this would be considered a very strong support area, an area where you could buy. So the market was not able to close below the BL. That means that the market was strong, and because it is above the pivot bias, we consider bullish, and the market finished on a positive note from the rest of the session. Let's see. This I think was a crude light yesterday, the day before. I can't remember. I think it was yesterday's session. Again, this is a dynamic level, and above here we have a PP and a RH. So all this area here is considered to be a very powerful resistance. So the market went up around 53.20, 53.30, and it got slammed down. It went through the reversal low, BL, went down to the first dynamic reversal low and target low, missed by a few ticks. And the target low, like I said before, is a good reversal area, but you have to wait for the timing. So buy when one tick above this high, for example, you put the stop here, and the market finished strong for the rest of the session. So you could have like 2 good points with timing again, because here if you use the timing, there's no timing yet. The market just went through the reversal low. You went through the BL. There was never a way. The market never fell this level here. It just went through like like a knife. You have to wait for the market to stop and say, oh, okay, maybe it feels this level. Let's see. Let's try to enter here, or let's try to sell here. Okay. This is still old stuff. 2012 on the mini Dow. Yeah, mini Dow. Again, this is the reversal high cluster, 2 levels. 480 and 70. Market stopped here and went down, and we tested a couple of times, went down. Then reached a reversal low to the tick up, and kind of felt a little more a couple of times here. But the best reversals are always, like I said before, in the first 2 hours. I always suggest when I teach traders to go with the trend the last couple of hours, especially on the stock index. All right, so this is all I want to talk about discretionary trading, what I like, what I think is a good methodology, a good way to trade if you like to get your hands dirty and trade using your brain. But if you're too tired, you have a job, you don't have time to stay in front of the screen, or you don't want to be emotionally involved in the market, then the second part is a quantitative strategy building procedure that I use to build the systems. So in this way, you just have a set of rules that have an entry, an exit, or multiple entry, multiple exits, and everything is handled by the machine. You are not involved personally on the decision when to enter, when to exit. So all the systems are programmed following a strict protocol to test for robustness and profitability. So it's not something like done by chance. One day you do one thing because you like it, one day after you do the opposite, then you're your friend using this indicator, and then it doesn't work that way. You know, that's a good way to lose some money fast. So I developed the system based on I have some objectives, some goals, something that I see on the market that I think could make sense for, because the market are constantly changing. So also your objective and your goals need to change. If the market doesn't trend anymore, you cannot start to build for example, a trending system, or a position trend following system if there is no trend in the market. So maybe it's time to build something that is more for the sideways market. Okay, so sell resistance, buy support. Then suddenly there's volatility is there, and there is a lot of trending situation and opportunities. Okay, so maybe it's time to build something that is more prone to trend following. So, you know, each market, they have their own personality. They go through cycles where they are very sleepy, and other time where they're very volatile. And you need to have different strategies that can take advantage of the condition of the market in that particular moment. So once I see these rules, when I see that some ideas make sense to me and that there are opportunities, then I see if those things I noticed can become a rule-based trading system. So if I can create something that is mechanical 100%. At the point, I program the set of rules, and it could be in TradeStation, but it could also be in Ninja. In the past, I used Ninja Trader, or like you saw, I programmed stuff in Sierra Charts, or even other platforms. We have proprietary platforms. So then I move forward with the backtesting once I have my set of rules that are creating the system. Okay, so I know when to enter, when to exit, with the stop loss, etc. So I usually backtest about 5 years at minimum for day trading, 5 to 10 years for swing systems, and 10 to 20 years for position systems. The markets are constantly changing, so probably what happened 15 years ago, it doesn't happen right now. So if you have a system that is adapt and is working well now, probably doesn't work super well 15 years ago, and vice versa. Whatever you created 15 years ago, if you have a system, I have a system that I purchased personally, or I developed 15 years ago, that were doing great for 1 year and 2 years, and then in market changes, the rule stays the same, and the system goes and it falls apart. You know, it goes in a drawdown, and you don't see results anymore. Okay. So how do I create the system? So I first test and develop the system on a set of data. Let me drink something. So I'm very thirsty. Okay, thank you. So I test and develop the system on a set of data that I call is an in-sample test I do first to see if the results are acceptable. Okay, so I see, for example, I use the data from 5 years ago for 5 years. And then I run a test on a second set of data that is out of sample. So if that in-sample is okay, then I say, okay, what happened in the following 2-3 years where I don't have the data? So it's like I'm working in the future, right? So it's out of sample. And to see if the results I obtain in sample are still valid in out of sample. And if they're still in line with past performance, then I'll move forward with the system and start to do some stress testing using Monte Carlo simulation, Wolford analysis, and other statistical stress testing techniques that we have in-house, and that, they're kind of sophisticated, but to make sure that whatever I see is not just some kind of random chance, and the system is actually really robust. And if everything goes okay, then I'll do a next route of sample. Then I test for another 1 or 2 years of unseen data. So after everything is done, the results are still robust. I will start what is called the incubation phase. So basically, I will follow the strategy in real time from a minimum of a few weeks to a few months to see if everything that now is happening in real time, live data and seen data live, is still in line with the past performance that I've seen on the backtesting. And often I will have to make some changes if necessary because the market changes sometimes and sometimes they're not. But the monitoring of the trading is constant. Okay, so whatever is going on now doesn't have to work 6 months or 1 year from now. So the system needs to be a little dynamic. The logic could be completely destroyed by the market behavior, and then at the point the system doesn't work. But usually, if you build the system in a good way, in a robust way, statistically you're putting the odds on your side that the market, that the system will work also in the future by maybe making some little changes, optimizing few parameters. But overall, you have a robust structure that will withstand any kind of stress that the future will eventually throw at you. And again, there is no guarantee, otherwise everything would be the holy grail, right? The indicators that I use are nothing like incredibly secret, or I use exponential moving average, different values, the ADX. I use the adaptive moving averages, DMI, RSI. These are the ones that I use the most. Stochastic momentum, and the ATR is very, very important. The true range is very important. For breakout, highest and lows are X bars are very important. Kerner channel, even Bollinger are okay. Then for the timing, I like a lot the price patterns or chart formation. For example, 1 to 3 high or low. Simple stuff, simple stuff is the best. And filters, maybe time of the day, when the market are more, there is more volume. I can use the pivot bias or the levels of the plan, and a few other proprietary indicators that I developed during the years. But pretty much, those are the main indicators that I see and I use in the system. Which are the 6 big advantages of the quantitative strategies? To use quantitative strategies. Okay, first of all, money management, risk control. Like I say, the objective is to cover in a systematic way all the different possible scenarios that could unfold during the trading session. The stop loss and risk control is automatic. It's not done by you, and the trader doesn't have to worry about not taking a loss. Usually that leads to a disaster for the discretionary trader. First, this is connected to the emotional trading. The system are always looking to find the best trading opportunity 24 hours a day. And once in a trade, they follow the rules and will exit without hesitation with a stop loss or with a profit. The same thing cannot be said with the discretionary trader, because emotion come in place and you don't respect your stop, or you exit too early your target, and that happens to everybody. It happened to me. It happened to anybody that ever did trading. The traders, the system don't do over trading. That's another part that a lot of discretionary traders do, is over trading. They kill themselves with too many trades. They build up too many commissions that also it's going to kill your profits. So the systems are active in the market, but they are not overactive. So 1 to 2 trades a day, 3 trades a day maybe, but more than that, you don't need that. The strategies are not trading just for fun, but the entries have strict filters, usually based on volatility, and historically they are proved to be profitable. Portfolio diversification is another thing, the main advantage of systematic trading, because there is an automatic diversification of a portfolio by using non-correlated markets such as crude oil, Dow Jones, natural gas, euro, gold, whatever. So if you diversify with different markets, then you have more possibility and probability to have a profit at the end of the month. But if you try to do discretionary, you cannot do that, because you cannot day trade or follow 5, 6, 7, 10 markets and be aware of everything that's going on, respect all the stop, respect all the targets. No, it's impossible. Human cannot trade intraday on a discretionary way more than a couple of markets. At least I can't. And for sure, he or she cannot trade more than a few hours a day. Otherwise, you're going to the crazy hours. You can take two hours in the morning and take a break another 2 hours. I mean, in the long run, you're going to last, unless you're Superman, you're taking some kind of drugs, few months at the most, okay, before you blow up your account the day you're tired. So automatic system, they're not tired. They're never tired. The systems are developed, again, like you saw before, by using a professional approach, and they're back-tested, and that is one of the biggest benefits of systematic trading. And while the backtesting performance is not a guarantee of future results, it can be very helpful in evaluating the strength and weakness of a potential strategy. The difference with a discretionary strategy is that you don't know what your things that you're doing right now did 2 years ago or 5 years ago, because you don't have a way to backtest everything. Or if you do it, it has to be a huge process, and it's very stressful. So we use a sophisticated statistical evaluation models in order to eliminate strategies that do not show robust performances and they have a good chance of not to work in the future. So there is a huge selection of based on statistical evaluation on everything I do. The last one is the systems are constantly monitored by me and by other professionals, and if necessary, revisions of the code will be made available to the clients in order to reflect the latest market condition and improve the current results. So again, brokers are monitoring via the servers everything goes fine. For example, that the stop and the target are reached, and again, if you run by yourself, you can always risk that you have an internet connection problem or something like that. So the trading system that currently offered are 4. This is going to be the 4 for now, but more will follow. The first one is a crude light short-term swing system. It works on a 15-minute time frame, and it looks to capture important movement on the crude light 24 hours a day. And for this system, I use the rate of change, adaptive moving average, ATR, and price patterns. The second is a mini Dow day trading. It works on a 5-minute bars and tries to capture the breakout long. Usually, it's a long breakout due to the bias of the stock market that is going up for the last 7 years. For this system, I use the ADX, DMI, ATR, RSI, and adaptive moving average. Crude light only long is the third system. So this system just looks for crude light only signal long. Is active during the session when the volumes are the highest between 5:30 and 10:30 Pacific Standard Time. And it looks, again, only at the long entries with price patterns with the help of stochastic and ATR. So you see the ATR is my most useful indicator. Crude light only short. It is active only between 5:30 and 10:30 Pacific Standard Time. So this means that the signals are going to be fired in that time frame, and not before or after. And it looks only to short entries with price patterns between with the help of the Kellner channel, RSI, and ATR. Now we can see some example of for example, this is the intraday crude light short. This is a winning signal. Just one signal a day. The signal was fired about 6 o'clock in the morning, Pacific Standard Time, out at 10 o'clock. This is an intraday short stopped. It was trying to capture this breakout, but then the market stopped, and it was stopped also, and there was for a small loss. This is short target intraday. There was a perfect breakout to the low side with the target. Sometimes the target could be a monetary target. Sometimes it could be a exit on close. There are different logic for the exit, actually. So we have a day trading long. We see a double signal. It was a double target, actually. A small target here, 6 in the morning, and then another one here. But the market went against us for a while. But then by the end of the session, it was also positive. We have a stopped long intraday. So the market was trying to go long here on a retracement, the breakout, but the market changed behavior and the market exited with a loss. Day trade long buy the target. Again, the market went down. Hypersold, buy, and exit the target. Okay. This is a YM intraday winning trade. I think it was in March, the beginning of the month. Again, just to show the example of the logic, like, if the market goes up, usually the system is going to capture that. But not always. So this is a losing trade. It looks like the market was going to the sky, and then it just stopped, and we acted with a loss. This was like 3 days ago, 417, 2 days ago, when there was a huge run up in the market, and went up long around 7 o'clock, 7:15 Pacific Standard Time, and exit on this logic on the Dow exit at on the close of Wall Street. Two most recent trades on swing. We have an entry stop short stopped out. It was about midnight, and then we have this short that actually went to be a winning trade. This was like a week ago, I think. It was 412. Yeah. One lose and one win on crude light swing. There was a signal at 10 o'clock Pacific Standard Time, so I don't think anybody would be awake that day at the time, but the computer and the system saw that signal and it exited at 8 o'clock. And then we had another trade around midnight that this one was actually a losing trade, went long, and then it was stopped out. So this pretty much kind of sum up all the things I have for you today. If you have any further questions, I beg you, and please contact the email at info@tradingquantstrategies.com, or you can call the phone number at 877-875-0640. And for any further questions, I suggest that you call the number or send an email. And I hope that you have enjoyed the webinar, and I hope to see you soon. Thank you very much.